QuickBooks Pro Desktop 2021 Bill Form. Let's get into it with Intuit's QuickBooks Pro Desktop 2021. Here we are in our Get Great Guitars practice file. We currently have the home page open. You can open the home page if it's not open by default by going to the company dropdown and home page. We also have the open windows open. You can open the open windows by going to the view dropdown, selecting the open windows list, making sure that it's not collapsed with this little icon here. We're going to be concentrating now on the enter bills form. Now remember, we're not actually going to enter the form here. We're going to analyze forms that have already been entered. If you want to get into us entering the forms and the things that need to be done in order to enter them, we will do that in the second half of the class when we then put together a new QuickBooks file and then enter 2 months of data. So if you want to actually enter the form, you can go there. Here we're kind of analyzing what is in the system, what the data is already. So notice that all of these icons are going to be basically forms, and that's going to be the data input form. The form's going to be necessary. That's what QuickBooks will use to then create the financial transaction. The financial transaction having at least 2 accounts affected so that we're in balance on the balance sheet, and will have an impact on the balance sheet and income statement. Our major 2 reports, balance sheet and income statement, or profit and loss, P&L. So as always, whenever we think about entering the data into the system, we want to first think about where it lies in terms of the flow. Is it vendor or payable? Is it a customer flow or sales type of flow, or is it employee? If we're in the vendors, that means we're paying somebody. The vendor means we're paying somebody else. So at some point in time, we're paying somebody else. And then we want to think about the transaction that will happen when we enter this into the system. When we're talking about a bill, that means that the accounts payable is going to be going up. So notice if you have like normal bills, and then what you're going to have then for normal type of bills, like a utility bill or a phone type of bill, you might say, I can either enter it as a bill, increasing the accounts payable, or I can enter it as a check, which would decrease the checking account as I put it into the system. Now, why would you enter a bill rather than just paying it as you enter it into the system? Because you might want to put the bill in place, and that'll be closer to the point in time that you actually consumed the good or service. For example, when you get the phone bill or the utility bill, if you enter it into the system right when you get it, then you're going to be entering it into the system closer to the time that you actually consumed the usage of the phone or the utility. And then you can sort the bills using this item over here or the various items we talked about last time. In the vendor center, you can sort by vendor, or we'll take a look at reports that can help you sort when the bills are due, and then you can decide when to pay them instead of having like a stack of bills on your desk that you're always looking through to see when the due dates are. You can wait until the due dates are at the end of the due date and then pay them off and sort that information within the QuickBooks system. So we're going to open up the bill icon, the form of the bill. We're going to go back to some previous bills that have already been entered. We're not going to enter any new bills. We're going to hit the back arrow up top and say, here's a bill that already has been entered. So notice the format of the bill. It looks kind of like a check here. That's by design because the bill is doing, in essence, the same thing as a check, except that the check would be decreasing the checking account. The bill will be increasing a liability, that being accounts payable. So if you see bill, anytime you see the bill, it's going to say that means accounts payable is going to be going up. So when you enter the bill, what's going to be necessary, let's just tab through the bill and the data input. We're going to have the vendor. The vendor will be set up. We checked out the vendor center before. We can enter vendors into the vendor center, which means you can go to here and go to the vendor center and enter them there. Or you can enter the vendors as you go, which is often the case. So if it's a new vendor, we can just type in a new vendor and enter the new vendor. Now, if it's the second month of operations, or beyond, the second month or beyond, you probably already have this vendor in your system. And therefore, when you enter the vendor, if you have your settings set up, and we'll talk about the preferences for the settings, it should then pull out the account already in use. And that helps you to be consistent. Remember, if you're taking over the job of someone else's bookkeeping, and you're taking over some position or you're moving into some type of position, you want to be consistent. And then if you want to change stuff, you want to change stuff kind of gradually as you go so that you can remain consistent. It's not usually good to go in there and just change everything unless that's what you're in there to do, you know. So that means that you want to be assigning normally the same account as you move forward, and then if you think things are better, then you can change them slowly in some other ways, right? So then we have the date the bill is going to be entered, the amount of the bill. We have the bill due date, and this is going to be when the bill will be due. So we can enter that into the system. The terms will help us to set that due date. So we don't have the terms here, but net 15 or net 30 would be due within 30 or 15 days, and it'll help to set the due date. The memo, it's always good to put a memo. If it was the Edison bill, you might want to put the month that was entered or something referencing the actual bill would be useful, which we don't have here, I know, but it would be useful to do that. And then you have the account. So utilities is kind of an appropriate account for the Edison bill. Note that you want to be consistent once again. So whatever they did last time, you probably want to be consistent. But with the expense accounts, you do have some flexibility. You might want to break it out between, not utilities, but break out the phone bill to be separate from the gas bill and the electric bill, all separate, or possibly, as is the convention, I think, mostly now, grouping together the gas and the phone and then breaking out gas and the electric and then breaking out the phone bill. But deciding how many expense accounts you want is one of the kind of difficult parts you have when you set up the company, as we'll do in the second half of the course. When you're taking over or just doing data input, it should already be set up, and it shouldn't be a problem because you'll be able to do what was done in the prior period. Then, of course, the amount will be down here as well. You can put another memo, which would be on the utility side of things when we look at it on the reports. If it's billable, then that means that basically you're going to use this item to create an invoice, meaning this bill that you're paying is something that you're going to kind of charge your customer for. So therefore, you can pick up a customer and then make it billable, and that'll help you to link that item to the invoice so that you can then help you to generate an invoice. We'll take a little look at that a bit as we go through the practice problem in the future presentations. That's going to be something that's often used for like a job costing type of system that you might have if you have longer term jobs like a construction company or even like a CPA firm or law firms might be using that item as well so that they can help to generate their invoices. So for more information on that, you might want to look at like a job cost system if that's something interesting to you. Then we have the second tab. Now this tab would be used if we were to be having a bill for inventory. So if we had a bill for inventory, then we're not going to have an expense. We need to be increasing. And notice when you go to this first tab, it's kind of deceiving. It says expenses here, but really it's anything that doesn't need an item, doesn't need something else that needs to be tracked. So for example, you might use an account like property, plants, and equipment and put it into there, and that would be an assets type of account. It would still be found under here. It really means that you're just going to be applying it to an account and don't need to be applying it to some other thing that needs to be tracked. Whereas if you were to go to the item tab, you need to track something else such as inventory. The most common thing would be inventory here that you're purchasing, where I don't just need to track the dollar amount and the account that it will be going to, but also the units of inventory and what inventory units will be purchased so that we can also track the units of inventory. So this will be needing to set up items. We'll talk about items later in order to populate this. So we'd have to have our inventory items here that we would be purchasing, and we'll talk about setting them up later. That's one of the more complex components to the creation or setting up of the QuickBooks file we will do in the second half of the course. Again, if you're taking over a QuickBooks file and doing a job for a file that has already been set up, then the items will already be set up, and your goal is just to learn the items that have been set up. So then you want to think about what's going to be the transaction related to entering this journal entry. Well, accounts payable, a liability is going to go up because it's a bill. So it always will go up because it's a bill. The other side's going to, in this case, go to an expense account, which will be the utilities. Let's take a look at another one. I'm just going to go back again. This is Spectrum. So that's going to be increasing the accounts payable. It looks like it's going to an internet, and that's an expense type of account. Those are the two accounts that are affected. Verizon, obviously bill, accounts payable is going to go up. The other side is going to be the telephone expense. That'll be an expense as well. Fender, this one's a little different. Fender is who we buy our inventory from. In our case, we buy and sell guitars. So that's one of our favorite vendors is Fender. And notice we're not on the expenses tab, we're on the items tab, which means we have an inventory item. So this is going to do a little bit more complicated of a bill. It's still going to increase accounts payable, but the other side is now going to go to the asset of the inventory. And notice it's not driven by the account down here, it's driven by the item. So the item is an inventory item that we set up. It's going to be these guitars. We bought 20 guitars. So this will be increasing the inventory account, which you might say, why can't I just choose the account on the expenses tab? You can, but it would throw things off because we also want to track the units of inventory we purchased, 20 units of inventory. So that's going to be the major difference ones. Just to note, this is when we first set up the bill. So let's close this back out. And now let's take a look at our two major reports, the balance sheet and the income statement. And you might want to take a look at the trial balance to have an easier look at this. So let's just test this out. We'll look at these reports in detail after this, but first we want to think about the transactions and start to think about the effect on the financial statements for these transactions and get a feel for the fact that two accounts will be affected each time. And then we will take a look at the reports themselves, including the financial statement reports. That will be the balance sheet and income statement. And then we'll take a look at the other reports, which are basically oftentimes supplemental to the two major reports. So the two major reports are going to be under Reports, Company, and Financial, the balance sheet down here. So Reports, Company, and Financial, and then you got to go down here to the balance sheet. Notice it's a little tricky to kind of scroll down. You can click on here once, you got the arrow over here, then scroll down and go to the balance sheet. This is the fastest way to get there. You can also go to the Reports Center, which we'll practice doing that when we get to the Reports section. So I go into here, and we're going to change the dates up top. Now notice there's only one date here. But if you want to be using the drill down or the zoom feature, it's nice to still have a range. So I'm going to go to the customized reports. I'm going to hit the date range is going to be 01/01/21 to 02/28/21. And you could make this for the whole year, 12/31/21. But there's only 2 months worth of data. Just make sure you're in the period of January through at least February or the end of the year. I'm going to say OK. And then the two accounts that are affected for these transactions, one of them is always going to be the accounts payable account. So if I double click on the accounts payable account, we will then see our bills. So there's only going to be two kind of things that typically will happen in the accounts payable account. We will have a bill, and notice how it indicates it over here by the type. That's really nice. It's really nice to go into here. This is kind of like a general ledger or GL type of account, but they call it a transaction by account, transaction summary. And so the bill is going to be a type of entry, and then we're going to pay the bill. That's what's going to happen. Now, when we pay the bill, we pay it with a check. But notice they mark it out specially. They don't just call it a check. And notice a check could include something other than a check. Anything that's going to decrease the checking account could be using the check form. But it's a special check form in that it's a bill pay check that tells us that the other side is going to accounts payable, meaning check decreases the checking account. Bill payment is going to decrease the accounts payable. That's the only two things that you'll see in the accounts payable typically, unless you have like an adjusting entry that is going to be in here. So if we take a look at one of these, like here's a Verizon bill. I think we looked at that one. If I double click on it, we can zoom back into the actual bill. So here's the data input. This data input then is what generated the transaction. So we don't enter it with a journal entry. We've entered it with a transaction. Notice it does indicate that it's paid here, which is a nice little indication that you have as well. So I'm going to close this back out. And so that's going to be the bill side. And then we have the payment of the bill, which is, of course, is going to be the bill payment, which we'll talk about next time, which is kind of like a check now. Looks similar to the bill itself, but then it has the bill connected to it down here that was paid. Closing this back out. Closing this back out. Now, the other side of this, we saw one, which was we bought inventory. So if I go back up to the inventory, we're going to say, all right, inventory was purchased. And if I look in the types over here, one was purchased with a bill. So it was purchased with a bill. We bought this inventory with a bill. And so here's the bill. And there it is on the item side. There's the inventory we purchased. So closing this back out. Closing this back out. The other side of this is going to be on the income statement sometimes when we paid the bill. We entered the bill for expenses, for example. So we'll go to the reports drop down, company and financial. We'll go to the profit and loss, changing the dates up top from 01/01/21 to let's say 12/31/21. So there we have it. And then down here we have our expenses. So this is our performance report. And within the expenses we have, for example, the telephone expense. If I double click on that, this could either have been paid. We saw in the first month we're going to pay for it with a check to show that. And in the second month we paid for it with a bill. If we double click on the bill, then we will see the bill item here once again, showing the bill item. Closing that back out, closing that back out. So that's how we can see it on the expense side of things. Notice it's useful to see these transactions, these two sides happening on a trial balance, because that means everything's on one report. So I'm going to go to the reports drop down, accounting and taxes, look at the trial balance, changing the dates from 01/01/21 to 12/31/21. Now you don't have the dates here. I mean, you don't have all the subcategories, and the debits and credits might throw some people off, but even if you're not used to debits and credits, and we'll talk a little bit about debits and credits, but even if you're not used to debits and credits, this is a nice report because it has both the balance sheet and income statement in the same area. So then I can look at this, I can say, all right, accounts payable is right here, double click on that, and I can choose one of these items to look at, and I can say, all right, let's just look at this one. There's that Verizon bill on 2/28. So the other side of that is in the telephone expense. So I'm going to say, I'll close that back out, and it's on the same report down here, telephone expense. I can go down here and say, let's check the other side. It's right there, telephone expense. So that's what I would practice doing every time you do a data input. And it's easiest to do that with a trial balance because then you only have one report and you can just basically check both sides that are happening every time you enter a transaction. Now also note that the accounts payable up top here was affected in the balance sheet. So the accounts payable was affected. That's a liability. That liability means that we owe people money. We owe the vendors money. Now we can also see that broken out in a report that's going to tell us who we owe the money to. We need a subsidiary report to break that out. We can find that here. We'll see this in more detail later, but just so you can check this out, this ties into the bill payment. We go to the reports, we go to the vendors and payables, and I want to look at the vendor balance detail report. Vendor balance detail, let's take this from 01/01/21 to 12/31/21, and there's our total. There's the 648. Which ties out to the trial balance at the 648. And if I was to go into any individual, these are the vendors that we owe. So now we can see who we owe. This is one way we can see basically what the outstanding balances are, who we owe. Now the other way we can see who we owe so we can actually pay them after we enter the bills into the system, the standard way would be go into the home page and then go into the pay bills, which we'll take a look at in the future, but then you can go to pay bills over here, and this sorts out the bills that are still outstanding that you still owe. We don't have a lot going on here, but we got one bill outstanding, but you can sort the bills using the pay bills, closing this back out. You can also take a look at them as we saw by going to the vendor center, and that lists out your vendors on the left-hand side and gives you a nice quick look at what you owe in total here. And you can go into the detail on each of these vendors. And oftentimes this will be entered with bills, and you'll see the transactions on the right-hand side. So back to the flow chart. So that's just basically the overview of the bills. So the bills, the next thing you're going to do after you enter the bills, of course, will be to sort the bills and then pay the bills, which will typically be this icon.